Thank you for joining the option trading lessons from ORE. To find out more, visit optionsReasy.com, but not until you've enjoyed this lesson on option strategies. Option strategies empower you as a trader to take advantage of almost any price action. After this lesson, you'll be able to trade a lot more than simple up or down markets. Here we're in the basic mode of the platform. First, we need to move up a level by clicking Go Advanced. This zone looks similar to the previous one, but it has two subtle changes. You can now see the options sell price as well as the buy, and there is a button named Turn into Strategy. A strategy involves buying or selling more than one option at the same time. Clicking the Turn into Strategy button adds more rows to the position. And each row is a new option contract, which we call a leg of the position. You can add as many legs as you want. One of the most popular option strategies is called the Long Straddle. It is commonly used around major economic events and allows you to profit from an increase in volatility regardless of price direction. Say, for example, there is an important announcement out of the United Kingdom. You may have the view that sterling US dollar price will move, but you don't know in which direction. You can use a long straddle strategy to trade this outlook. This strategy works through buying a call option and a put at the same time. And as you know, a call brings you a profit when the market price rises, and a put brings a profit as the market falls. Both options have limited risk. So to create this strategy, we need to set up two legs. The top leg here will be the call. First, we select the pair that we want to trade, sterling to US dollar. We will keep the strike at 0%. A 0% strike simply means that the strike matches the mid rate of the current market price. We need to select the expiry date of the option and the trade size. The second leg will be the put option. The currency pair is already matched automatically. We select a put, and we want the strike to also be at 0%. The expiry is matched, and we'll match the trade size to 10,000 as well. Now note that for a long straddle, the strike of the call and the put option are always the same. So here we have the strategy set up, and I've selected to buy both legs, each leg costing around $60, so that'll be a total of $120, or in our own domestic currency, that's £80. But before we go ahead and trade this, let's check the payout by clicking on the Scenarios button. So here is the payout at expiry over a range of sterling to US dollar rates. The strike rate of both the options is the center of the chart. Here this is at 148.55. And you can see as the market moves away from this strike, either up or down, the profit grows. You can see as sterling US dollar rate increases, the profit line is growing. And as sterling US dollar rate decreases, the profit line also grows. So as long as the pair moves far enough up or down, this strategy will return a profit. The break-even points are the points that land on the zero line of the chart, or the rates that give zero profit or loss in the table underneath. If sterling US dollar does not pass these points by expiry, then the strategy will create a loss. This loss is limited to the premium paid for the strategy. In this case, that's around $120. And this maximum loss will only occur if sterling dollar expires at 148.55. By studying the profit potential, the break-evens and the maximum risk, you can evaluate if this is a good position to place or not. Here I can see that I will make 100% profit if the rate moves from 148.55 up to 150.95, or if the rate moves from 148.55 down to 146.14, and I know that my maximum risk is $120. If you evaluate this as a high probability trade, then you will take the position. But if you don't think sterling US dollar volatility will be high enough to bring you your wanted return, then you should not take the position. Now, as well as studying the payout at expiry, you can also look at the present payout. This gives you an indication of the near-term move that's required to bring you a return. Here you can see that if the market rises to 149.72 or falls to 147.31, then I'll begin to make a profit. And at the present time, my maximum risk is just $23. Now, the advantages of this strategy are that you can trade a move in the market without having to take a move on direction. And the risk is limited without the risk of getting stopped out. The disadvantage is that time value is against you. That is, for each day that passes by, the strategy's payout is declining. As explained in Lesson 3, options lose value as they get closer to expiry. Now, if you're happy with the strategy and your potential payout, you close the scenario tool and you click Trade Now. Whenever you open a strategy, you'll be asked if you want to publish it in a strategy's marketplace. For now, we'll choose No Thanks, as we'll cover this in later lessons. Here we are in the open position screen. You can see the amount we paid for the option at around $120, the current value of the option at $97, and if the market moves up or down, the current value will increase. You can monitor your running profit or loss, and you can close the position at any time. To review the legs of the strategy, you click on the small arrow here, and to re-evaluate your position's payout at any time, you click on the scenario button here. From the advanced trading mode, it is possible in just a few clicks to create hundreds of different types of strategies. In subsequent videos, I'll be showing you more. To practice trading, go to optionsReasy.com, and if you have any questions or feedback, please email info@ore.com.